Welcome to the Wealth Transfer Podcast, where we unpack the strategies, structures, and conversations that shape how wealth moves across generations. I'm Matt Templeton, and in each episode, I speak with the trusted professionals, from estate attorneys to transition advisors, who help families steward assets, avoid costly mistakes, and build lasting legacies. Whether you're planning your own future or you're one of the people guiding others through it, this show is your front row seat to the smart conversations around wealth transfer. Let's begin. Today's episode is packed with great insight for real estate owners, especially those who are thinking about retiring, or maybe they've got a lot of appreciation in that real estate portfolio and they're trying to figure out, how can I start to get access to that equity, or how can I make more cash off that equity? How do I get out of things that are maybe a noisy asset or something that's a little bit annoying and I don't want to own anymore? And learn about 1031 exchanges. Today's expert, John Taylor, is going to tell us all about 1031 exchanges, the right way to do Delaware Statutory Trusts, DSTs. Maybe you've heard of those before and you've heard bad things, but they don't have to be bad. They actually are really great if you select the right one. And also about 721 exchanges, which would allow you to go to 1031 into a REIT after going into a DST. So getting all the way to a REIT, of super liquid real estate ownership piece, so that you've got that opportunity in the future as well. So lots of cool strategies we're going to talk about with John today. He's very knowledgeable. He's very savvy. I'm very excited to bring you John Taylor. He's an investor. He's an advisor. And it's going to be great for you to hear how he thinks about real estate investing and advising his clients on making those decisions. So this conversation is going to give you some great practical tools, and also how to practice the transferring of wealth, what we talk about on this show. So I'd like to welcome John Taylor to the show. Well, John, the first question I would love for you to explain is, give us your bio, give us your experience in both wealth transfer and financial advisory, and tell us why you're a person that should be on our podcast.
Sure. Well, Matt, I appreciate you having me very much. It was great to meet you and spend a little bit of time with you. And thanks for having me on your platform. My story is interesting. So I was a business owner. I ran a marketing company with some partners. We grew to about 20, 25 employees, and the company was sold. And when that happened, it created a pivot for me in two different ways. One, I needed to figure out what I was going to do when I grew up. At that point, it was an opportunity for a career change, but I also, for the first time ever, had a little bit of money and had an opportunity to make some investment decisions with a broader perspective. And so I found my firm, JRW Investments, through my own search as an investor. So our firm, we underwrite commercial real estate that is packaged for passive income investors. And one of those tools is a Delaware Statutory Trust, which we'll talk about. But another very common investment vehicle is a syndication or a limited partnership. And that's what I was curious about. And that's how I found JRW. I fell in love with the due diligence office at JRW and the way that they evaluated offerings, what they approved and why they didn't approve some specific investments. And I trusted them. And so during that time, they offered me the opportunity to join them as an advisor and as a registered representative for their broker dealer. And I have started to work with my own clients ever since.
That's awesome. I'm dealing with a lot of private equity and family offices in Dallas. Obviously, due diligence is really important. Yeah. And even being in real estate for a while and looking at a lot of syndications, especially for a while there, multifamily syndication was so popular. And now some of those are coming back and they're not performing as well as you would have hoped. Yeah. So due diligence, it really matters.
Let me camp on that for a second. One thing that's really cool about our office and the due diligence that we provide, and we offer this we fully expose this to our investors who are interested in making investments. We re-underwrite the pro forma for the next 10 years on any investment that we're reviewing. And we look at it through the perspective of, we're going to buy this entire project. Even if we have an investor who's only interested in making a $100,000 investment in a large scale offering, we'll basically take the address and we'll run it through our own independent third-party tools as if we were the acquisitions group and the asset management team for the sponsor company. And then when we do that, we have a stress test, and we can stress test 25 variables that we think make or break a deal. And we will do that live with the investor. We'll say, okay, what if rent growth is here instead of here, right? Let's just not say 3.5% rent growth. Let's look at the market for the last 10 years, and you pick a number based on the data that's on the screen that you can look at. Let's look at occupancy. Let's look at expenses. Let's look at property tax potential changes. Let's look at insurance potential changes, right? Things that make or break a deal. And to stress test that with an exit cap rate range, good, better, best, we find to be extremely refreshing for our investors who are looking for solid due diligence that they can participate in.
Well, and the certainty. And, oftentimes when you're getting presented a syndication, you're being pitched, you're being sold, like they're the salesperson with the optimistic numbers, and maybe they've had an analyst give it a reasonable set, but you're like, this is actually the best case. This is not the reasonable case, right?
Well, we understand that because we have sponsor companies that are pitching us, right? They're coming into our office with their shiny package and saying, look how great this deal is going to be. And listen, we would love for them to be right. We would love for that to be true. We understand that's hard work. It's hard work to go and do the acquisitions and the asset management, and it's easy to write a check. So we don't take that for granted, but we also don't just take it, wholesale. We want to evaluate that. And so we stand in the gap between the wholesale groups out there who are building product and for the investors who are making investment decisions. And I think for us to have, last year we reviewed probably 400 different deals, and I think we approved like 15 to 20. And of the 15 to 20, there's categories of approval, and they're not suitable for every investor based on their goals, needs, liquidity, life stage. And so we're not ever going to present everything to an investor. We're going to curate specific investments that both meet our requirement generally, but also the investor's requirement specifically.
I love that. So tell me a little bit more about what JRW actually, you've got a due diligence office. What are the products you're offering? What are the services you're offering? Tell me about the company.
Yeah, that's a great question. There's approximately 35 people in the company with JRW. 7 of us advise clients directly as registered representatives. The rest of the team, they support investors or they support advisors. And so when an investor makes a investment with us, we are reviewing that on an ongoing basis, which takes due diligence resources. We're also providing support to investors through our investor relations department and client services team. When they're doing a transaction, that transaction process, we try to make that as white glove as possible for the investor. We don't send them, a 45-page PDF and ask them to send it back to us, right? We have, through our onboarding and account initiation process, we have a lot of their information on file. And so we'll pre-fill as much as we can. Our office is definitely built to serve our current clients. We have about 3,000 clients who would call JRW Investments their primary advisory firm or wealth management office that they depend on to review investments that come their way. And we have to have that continuous operation built just for when these investors are ready to make investment decisions. And so going back to your initial question, what do we review? We review private, non-traded, and public non-traded REITs. We review private equity funds or bridge loan funds. We review syndications or limited partnerships. But the primary, I would say, function of JRW, the primary focus is this maybe little known investment vehicle called a Delaware Statutory Trust. It's one of the few investment structures that requires financial licensure to represent, but it's eligible for the accredited retail investor to use as a 1031 product. And so 1031 exchanges have always been kind of what we've built the firm around, because those investors have needs that are sometimes forced upon them. But when those needs become imminent, it's a very short duration that they have to make a really smart decision. And if they're looking at the entire Delaware Statutory Trust market, they just simply don't have enough time or resources to evaluate that properly.
So let's break that down. So a lot of people have heard of the phrase 1031 exchange, and they know it means I'm going to sell my real estate and I'm not going to have to pay capital gains because I'm going to transfer it. But what really is the meat of a 1031 exchange?
Yeah, so a 1031 exchange is only eligible for an investor. So investment property is simply property that you do not use for personal use. So it's not your primary residence, it's not your second home or the place that you vacation with your family, right? It's an investment. It shows up on your tax return as such, so it's very clear. If you have an investment that has grown in value significantly, or that you've held for long enough that you've depreciated the value significantly, now you have a significant capital gain. And if you sell that property, then you pay the capital gain. The 1031 exchange is named after a tax code that allows you to transfer the tax basis into a new investment property. It needs to be property held for investment. It doesn't have to be the same exact type of property. So you may have heard the term like-kind property. Like-kind just means investment property. So you could sell a condo for a duplex. You could sell a single-family home and you could buy a commercial property. You could buy raw land, right? There's a variety of different asset classes inside of and underneath of the umbrella as real property. But generally speaking, those are some of the questions that investors have when they come to me is how can I sell this to buy this?
Well, I think you brought up a good point. Like kind is investment to investment. I remember 10 or 15 years ago, and I don't know if it was a court decision or if there was a statute reinterpretation, there was an understanding that like kind meant same asset class, right? Like residential investment to residential investment, land to land, commercial to commercial. But now it's become much wider. You can go investment to investment, and there's all sorts of fun ways you can do that. And maybe that's even what's opened up the popularity of things like a DST or moving into REITs or things like that, is that you've got a little bit more broad range than what the statute might have originally had. So what is this, we use jargon sometimes, we got to break it down. What is this DST, Delaware Statutory Trust? How does that fit into the 1031 exchange situation?
Sure. Yeah, to oversimplify it, a Delaware Statutory Trust is an investment vehicle that allows a retail investor to buy a large commercial property fractionally. So how is that possible? A Delaware Statutory Trust was granted an IRS revenue ruling in 2004 that created a bunch of restrictions and requirements every time that a new Delaware trust was structured, but it also enabled the 1031 exchange industry to take that vehicle and use it in a variety of ways. So a Delaware Statutory Trust is simply a grantor trust. If you have a living trust is a grantor trust. It's an empty bucket with a charter and a bunch of restrictions and regulations until you put an asset into it, right? So the asset is acquired, it's granted to the trust. Perhaps if there's a loan on it, that loan is also acquired through the trust vehicle. And it's operated on behalf of investors by a sponsor company. Sponsor company, they buy the property, they grant the property, they operate the property before any retail investor participates. So they take on all of that initiation startup risk. And then they're the ones primarily selling the beneficial interest units to the investor. So the investor basically plays the part of the beneficiary of the trust. So we got a little complicated there, but to oversimplify it, any piece of real estate could be inside of a Delaware Statutory Trust appropriately structured for 1031 exchange investor.
How does this differ from, like, maybe somebody's invested as a limited partner in another real estate syndication previously? How does this differ from that?
Yeah, there are a couple key ways. So number one, it is primarily a 1031 vehicle. And so for 1031 exchange investors, they need to buy like-kind property, which is real property held for investment. Many of the syndications that are out there that we review, it's purchasing raw land and then developing that land, or it's buying a distressed property and redeveloping that property. And all of that redevelopment or development budget is not eligible for 1031 exchange funds. So sometimes we see a hybrid DST that requires an investor contribute 1031 capital as well as balance sheet capital, but that's very rare. And so to oversimplify the differences, it's a stable tenant in place, currently cash flowing real estate investment for the DST, whereas the syndications are usually value add or opportunistic or speculative in nature.
And then the way that the title is held, or the entity that title is held by, is just slightly different for tax purposes.
It is, correct. Yeah, the syndications, typically you are an owner of a partnership, not a property. A Delaware Statutory Trust, you own the property directly, fractionally. Okay, so you're going to have a Schedule E, just like you did with your rental property, right? With a syndication, it's a K1, right? And everything is inside of the partnership agreement. But with the DST, it's direct property ownership through the trust, you're 1099 at the end of the year instead of a K1.
So now we were talking about 1031. DST is a type of vehicle that you can do with a 1031 exchange. Why would somebody consider DST over just going and identifying their own property and doing a 1031 exchange traditionally?
Yeah, that's a great question. My typical investor is 75 years old. Okay, like scatter plot, like the center of that scatter plot, they're 75. And I would say primarily that investor is attracted to the Delaware Trust because of the reduction of management burdens that's inherent. It's the only real estate that's truly passive to them, right? They'll never get a phone call from anybody. They just simply are the beneficiary of the economic outcome of the property. So for my retiree investor, their goals are to simplify their life, to reduce their management burdens, to defer their taxes in perpetuity for the rest of their life, and to receive stable income as a result. And so the advantages that the DST provide are directly tied to the properties in the DST, not just the structure, right? And so this enables my retiree with $1 million investment to buy something that's a $600 million property or a $300 million property or a portfolio of 25 different properties that are up to 250 million. So there's this theoretical risk mitigation with a transfer of asset class and also a significant exposure to real estate, on a broad level. So that's why somebody is attracted to the DST. I will also say that it's not uncommon for me. I mean, it happens a statistically relevant amount of time where an investor will do a 1031 exchange and purchase a sole ownership property locally and also a Delaware Statutory Trust to completely satisfy the entire 1031 exchange.
So then that would be like they have boot left over and they need to move it into something. So in order to make sure that it gets finalized, they have some extra that they need to put into a fractional ownership of something, right?
I think for your audience, that's a really good point to understand, right? If you have a 1031 exchange opportunity, you sell $1 million property for easy math, and you identify with your local listing agent or buyer's agent a great investment property for $800,000. I would say the typical investor just lets the $200,000 go into a tax bill. And what I'm suggesting is that's a great opportunity to look at the Delaware Trust for the advantages of the assets you can own there for $200,000. Because let's face it, $200,000 is a difficult number to place in a large part of the country and see a positive return on your investment.
Let's say I'm just starting to explore the idea of selling an investment property I've owned for a long time, or I'm kind of considering a 1031 exchange. Why wouldn't I just keep the property I currently have? Why would I even want a 1031 into a DST?
I always tell investors, I enjoy the consultative process. So I'm not certain that a Delaware Trust is the ideal outcome until we arrive there. I'm also not certain that a 1031 exchange is the optimal outcome either. So I always tell investors every day you can decide to do one of three things. You can hold the property that you own, you can sell it, or you can exchange it. Those are your three options. And so let's talk about why you might do one of those three today. Why would an investor hold? It's because the property is performing optimally. It's optimal in their market or it's optimal nationally, right? The 1031 exchange opens their eyes to the fact that they can own anything, anywhere. And so if that's the case, it's truly an investment, right? It's not a utility. It's not something they use. It's not emotional like their home. It's an investment. And so numbers and returns should drive decisions. So we look first at the current performance of their current asset. And we say, it is or is not performing optimally in your local market, right? And that's a great opportunity just to encourage them. Hey, you can raise rent here, right? The property next door has higher rent than yours, right? And we're going to do that analysis for them and with them. And a great outcome of a consultation with me is just that confidence to walk into, the tenant and expect a market rent for the property. There's so many properties that are below market rent. Let's say that you are at market rent, but your cash on cash return or your cap rate is like 2% or 1%. I'm in Southern California. Our office is in Pasadena. We work all over the country, but we tend to attract the markets that are significantly appreciated. Okay, so in markets like mine in Southern California, we have investors who've experienced appreciation that has far outpaced their ability to raise rent. Maybe it's rent control, but oftentimes it's the fact that assets are extremely valuable, right, to the end users and to the buyers, and the renter can't keep up with that pace. In that case, we would say your market, you may be performing optimally for Los Angeles, but you are definitely not performing optimally compared to what I could buy in Tennessee, in Texas, in Florida. And so that opens their eyes to the fact that, hey, there are opportunities out there for me to enhance or upgrade my investment, right? Specifically.
Yeah, here in California, A class is a 2% cap rate. So,
I just did an asset performance review for a client yesterday on 3 different assets. One of them was a 0.94% cash on cash return. The other one was a 1.85, and the other one was a 2.2. And the 2.2 is actually exceptionally good, and it's because they had an ADU and they had a duplex, and it was a unique property, and it was working much better than the rest. But that's not uncommon at all.
Well, and I was asking kind of a leading question because obviously we help people sell real estate, and sometimes it's like, well, I've owned this property for 30 years. I like it. It's not hurting me. It's not that noisy. I'm enjoying owning it. But then when we do the math on both appreciation or even on the depreciation, right? You're not getting any tax benefit anymore. You start doing the math on the return. And again, the cash on cash may not be there, and neither may the cap rate, right? It might be you can't really raise market rents, and you've got better opportunity for better cash flow with even less noise, even less headache. So that was a leading question, but I think it's important because I think sometimes we get caught up in, I've always owned this, I'm just going to keep it, versus why don't I start making things simpler for myself? Like if you own $1 million property, but you've been running it as if when you purchase it at 200,000, you probably aren't getting a 5% cash flow on your $1 million of value like you could be if you were in a DST, right?
That's why I enjoy working with local agents and brokers all over the country who understand their market cap rates, right? Because it's very common for me to identify an investor in a high value market, New York, right? South Florida, Portland, Oregon, San Francisco, Los Angeles, who they would look at a Dallas, Texas market and say, I would love to participate in the growth that's happening there. And I'm fine with a 4.5 or 5.5 or 6.5% cap rate. So for me, I love the idea of exposing. If an investor is ever going to consider selling, they need to understand specifically what can they buy and what are the advantages in making that move.
That's awesome. Okay, one question, you sort of answered it, but I want to get some clarity on it. Is there a minimum gain that an investor could have or would have that would make sense for them to go into one of the DSTs you recommend?
So going back to that framework, if we're looking at the asset's performance and we decide it's suboptimal, the next thing we're going to look at and say, what are the consequences of a sale, right? 3 options: hold, sell, exchange. The consequences of a sale are directly tied to their tax basis relative to their sale price. And we will run a back of napkin estimate that shows in approximation, this is what we believe your capital gain would be. And based on your income and your tax rate, this is what we think ballpark your tax bill is going to be. Here's what we think. Go speak to your CPA and see what they think specifically. It's a project that they can work through in about 10 minutes and get that back to you and look at our numbers and compare them. If the gain isn't significant relative to their equity, and this changes in different market cycles, but today I would say if their tax bill is 15% or less than their equity that they would get out of their net sheet on a sale, we encourage them to strongly consider paying the tax because they have an option to wait and redeploy without the deadlines and the requirements of the 45 days. It's not common for my retiree investor to have that sort of scenario. So when we look at that ratio, tax bill to equity, we typically see 30%, 50%. If it's a leveraged asset, it's not uncommon for us to see a tax bill that supersedes the equity entirely. You're upside down on your tax bill. And so that calculation is extremely important for me to advise on the 1031 in general, because if there is no tax consequence, then it's a opportunity to sell, liquidate, turn it into cash, and now you've freed yourself up to have a lot more flexibility.
That's a helpful point. So if you've leveraged or if you've refinanced and you've pulled cash out, you essentially already got your gain out, but you haven't experienced the tax consequence of it yet because refinancing is not a tax event. But It is important to recognize that if you've pulled all that out and then you go to sell, and you've already spent that money or redeployed it into another investment or something, you may have to. You may need to do something like this. That's a great point.
Something else that's maybe obvious if you think about it, but it sounds odd when you hear it for the first time. every dollar in your appreciated asset that is leveraged, every leveraged dollar is 100% capital gain. Okay, so you need to understand that the 1031 exchange tax consequences, like if you understand the tax consequences, you appreciate the value of the 1031 exchange even more. So I always encourage investors to know how to read their own tax return and make their own calculations. And if they don't know how to do that, or they're not comfortable or empowered to look at their own tax return, I've greatly enjoyed walking them through that process, or sending them to their tax advisor for their specific and individual capital gains analysis.
That's great. Well, I always like to span the whole range. Like I love to talk to people who have a couple, maybe single family investments, because 1031 is very accessible. It's actually something that even if you only have a few assets in investment in real estate that you want to sell, it makes sense. But then also we have people with humongous portfolios, and they've got much more complicated tax scenarios, and obviously they need much more advice from a number of different players, whether it's their state attorney, their tax attorney, or their financial advisor, their wealth planner. And so there's a lot more complex. And I love to span that whole range in these conversations. And one of those strategies that I feel like it can be kind of all over the board, but probably more on the higher end side is the 721 strategy. And so I would love for you to break that down. It's an advanced strategy, but I think a lot of our wealthier clients would probably appreciate realizing that they can go from a DST to a REIT. And tell us about 721.
That's a great leading question. We'll go advanced level thinking for a minute. Okay, so 721 exchange is a tax code just like the 1031 exchange, and the 721 exchange is a cousin, I would say, to that. There's no gain or loss recognized when a operating partnership acquires an asset and that asset is transferred into that operating partnership. So we see that a lot in mergers and acquisitions. When a larger company buys a smaller company and they roll that up, that's not a taxable event. The 721 exchange is used more broadly than what we are going to talk about. And that's good to know, right? Because you may have heard the 1031 exchange has come up on the chopping block in various federal administration tax reform bills. And that has happened consistently going back a number of federal administrations. The 721 exchange has never come up. Okay, so that's a nice protective measure that we've seen a lot in the DSTs. So how does this enter our world and the investors' world? There's 65-ish sponsors of DSTs. Today, there's 88 different offerings available that we've reviewed. That's the comprehensive market for DSTs today. Of the 65 sponsor companies, 8 of them operate public REITs, real estate investment trust. Little known fact, a real estate investment trust is also a Maryland statutory trust, but they had dibs on a really cool name. So even though a Delaware trust is far more real estate than a REIT, that's just a kind of an aside. So when a REIT purchases real property, it can offer a 721 exchange for operating partnership units of their REIT. It's a share class that's eligible for the tax-deferred exchange into the REIT itself. If you look at the list of sponsors last year who raised capital into the DST market, of the top 10, most of them operate public REITs. And most of the reason why the retiree is moving into those DSTs is because they value the REIT as an exit option for them. Why is that valuable? The REIT offers theoretical diversification that comes from transitioning from a $50 million asset to a $5 billion fund of assets, okay? Or they value liquidity. A Delaware Statutory Trust has no redemption program. There's no cash in the DST. It's ownership of real estate. So there's no cash until the real estate's sold. A REIT has balance sheet capital, and they typically have 5% of the entire assets under management set aside for their redemption program that allows investors to say, I'd like money out. When investors take that money out, it's a taxable event. So why is this helpful as an advanced strategy for maybe your financial advisors out there, or for the family offices, or for the high net worth individual? Well, let's play out kind of a multi-step process over time. You own an asset that is under your control 100%. You recognize that there's advantage to sell it, perform a 1031 exchange, and ultimately you'd like to be in a vehicle that has liquidity and significant diversification, you pick a DST that has that exit option. And within 2 years, 3 years, 4 years, you're in their REIT now. A significant advantage that we always talk about is the estate planning minded investor, right? I'm going to talk about like the D's of real estate investing. There's defer, die, and distribute. Okay. So once you defer your tax your entire life, you're doing that on behalf of yourself for your lifetime, but also a significant advantage for your estate. Right? When you pass away, your tax basis is adjusted either halfway up to fair market value if your spouse is surviving you in a non-community property state, or it's all the way stepped up to fair market value, meaning if you sold it the day that you pass away, if your estate sells it, there's no tax consequence, right? The capital gain is completely eliminated. The REIT enables that successor spouse or generation to liquidate very quickly. So a common challenge for real estate families is the distribute D. If you own one commercial property that's worth a significant portion of your estate and you've got 3 kids, what's the plan there, right? Well, somebody will have to sell the property. And my suggestion is that for that sophisticated retiree real estate investor who's in their 70s and 80s, it ought to be you that sells the property on behalf of your estate plan to create a lot more flexibility and optionality for not just your surviving spouse and your kids, but for their advisors. And so that's why it's attractive. That's why, it's the most popular DST on the market. It is one that has a REIT exit. It's because of those mechanical advantages. Now, caveat, you need to be really careful with the investment itself. Whether it's a DST or a REIT, you need to understand what you're buying. And you need to be really careful if the REIT has financial fundamentals that offer challenges for them currently, but also risks in the future. JRW Investments would not approve every REIT that's out there, just like we would not approve every DST.
Well, in a second, I want you to break down a little bit more of that due diligence that helps you to identify which ones you might approve or not approve. But even in a DST that doesn't transition into a REIT, you still have, whether you don't have immediate liquidity, but you've got a much faster liquidity or a much more certain liquidity event than we have to figure out how we're going to sell this property and manage it after mom or dad dies or whatever else. So maybe riff on that for just a second, because the DST itself is still a great way to set up your assets to not have to spend a bunch of time figuring out how to get them sold.
Absolutely. The REIT phenomenon is like 4 years old, right? We're in 2025 today. In 2019, the REIT concept wasn't really mature. It was just sort of getting formed. And so we were still very significant investors and participants in the Delaware Statutory Trust market for the estate planning benefits, just like you were saying. So what happens when an investor passes away with a DST invested? Well, it's immediately distributed fractionally, right? The fractional ownership vehicle is an advantage where if you have in your estate plan, if there's 3 or 4 or 10 or 50 beneficiaries at whatever fractional level, we, as your investor relations group, right, we serve your family as well. So we get the date of death appraisal and we distribute per your estate plan in conjunction with your estate planning attorney or successor trustee that distribution, and it's immediate and it's painless and it's free from a investment vehicle standpoint. And those individuals will get their individual returns immediately as well. So they get individual monthly cash flow, they get individual tax statements at the end of the year. And as you said, they're not responsible to coordinate the sale, right? The sale is coordinated by the institutional real estate company on behalf of all of the beneficiaries. And I would argue that that's an ideal outcome for most real estate heavy, families.
Totally. Well, and even just estate distribution and working in general, it's already a headache. Even if you have a corporate trustee, even if you have professionals who are handling it, it's a headache for the family. It's a burden. And to be able to know that almost immediately you're going to have distributions to the family on those specific assets and that it's already taken care of. Because I think too, like many times these assets start to degrade around the end of the owner's life. And so then they're thinking about transferring, in the next 5 or 10 years, but they're still maybe extracting cash out of the properties. And then the family gets it. And then they've got something that's an eyesore, that's a frustration, that's a hardship that they don't understand, that they didn't get the correct documents. So if you as the original owner, before you pass away, can settle this up and go into something so easy as a DST, it's like, it absolutely makes sense in my opinion.
Yeah, it's a blessing for the family every time. The estate planning attorneys will tell you, who have experience with this, that this is the easiest part of the distribution and the transfer.
Okay, let's go wider past DST and 1031. Although I think if someone's thinking about doing a DST, they need to consult with you to find out what you would recommend and partner with you to put their money into those things. But let's go wider, because you see a lot of wealth transfer. You pay a lot of attention to helping advise wealthy families on the right decisions, what's right for them, regardless of what the different products that are available are. And so I'd just be curious, what are some of the most egregious mistakes you see families or even wealthy individuals make when they're kind of setting up these estate plans or when they're thinking about some of these different options?
Good question. By far, the biggest mistake that people make, they put their children on title for their property because they want to avoid probate. And they're not receiving good advice or correctly understanding the way that the taxes play out. If your children are on title while you're alive, then your children inherit the tax base the day that they get put on title. And when you pass away, that tax base stays there. So instead of that $1 million property that has a tax base of 100,000 stepping up to $1 million, right? It's stuck at 100,000 after mom or dad pass. Now they successfully avoid probate, but they just created a $300,000 or $400,000 tax bill for their kids. And that's by far the biggest mistake that people make when they're structuring that. The other mistake that people make is they don't have a trust set up, or they have a trust set up, but they don't have all of their assets contributed to the trust, right? It's very common where, we're working with investors and they make a 1031 exchange transaction in the name of their LLC or in their names personally. And it always triggers the question, do you have a living trust? And if they don't, we encourage that they get that set up with their attorney. And it's a very simple assignment when they own a DST. It's the same as if they, own the property on the street. They'll work with title to change the title, and therefore, that property would be granted to their living trust.
All right. Now, the last question I want to ask you, because I'm certain that some of our advisors and attorneys and others are thinking like, wow, I want to get more information on this so that I can collaborate with JRW. How can people connect with you? How can they collaborate with you? Obviously, you sort of specialize in specific products. So even financial advisors or wealth advisors in other categories may want to refer people to you because you don't deal with the same stuff they deal with necessarily. How can people connect with JRW and with yourself?
Yeah, I appreciate that. I mean, a great referral partner for us is the qualified intermediary, right? They're the groups that handle the funds, right? A financial advisor who doesn't have a real estate office or a due diligence office, they're depending on our due diligence, right, for their clients. That most of the time, the real estate investor is underserved, generally speaking, by their professional resources, because what they've done has always been sort of like homemade, right? They've been focused on doing it themselves, and now they're in need of support. The agent or broker who's working with investors, right? Oftentimes they're asking us to come in and educate their investors or educate them on some of the nuances and the opportunities here. You can simply reach out through email. So it's jtaylor@jrw.com, or you can call me on my cell phone, right? It's 440-463-0128. It won't take too many tries to get me there, but we work with folks all over the country. We're based in Pasadena, but our primary, our focus, it's all virtual today, or we're traveling around the country speaking.
Any final thoughts or just general advice you would give to people considering how they transfer wealth to the next generation?
I think there's a lot that's currently out there that's, for public consumption on the internet, about the structure of the 1031 exchange, about different investment vehicles, right? The Delaware Statutory Trust, the 721 exchange, the REIT. It's much more well known today than it was 5 years ago when it was little known. And I'd argue that 5 years from now, in 2030, lots more people are going to understand that that's an opportunity. What I would caution investors today is to really do your diligence on your current situation, your current tax scenario, right? You're going to work with your listing agent and with your CPA to understand those things, right? But you also need to identify a broker or an agent who's going to help you buy something that has advantages as well, that are in a format in which you can directly understand the outcome. I think a lot of retiree real estate investors think that buying into a DST is not buying real property. It is. Your economic outcome is directly tied to the property in that DST. And so you need to understand it really well. And if they don't understand it really well, I would advise that they not do it, right? Because it's an easy product to talk about the advantages of the structure, the advantages of the strategies, right? The tax bill, the tax deferral. But the real value is your ability directly to understand and feel empowered that you're making a great decision on the piece of real estate that you're buying. And if you can ask your broker or your agent a simple set of questions about that property, right? The 25 variables that we think matter, right? If you can go down that checklist, then you're going to be pretty certain that what you're purchasing contains the recession resiliency or the economic stability that you as the retiree are looking for.
That's it for today's episode of the Wealth Transfer Podcast. If you found value in this conversation, would you leave us a review? That would be just so honoring to us. We'd appreciate it. And if you know somebody who might need to listen to this because they're thinking about their next chapter, will you send them a link to this podcast or this video so that they can listen more as well? For more episodes and expert insights, be sure to follow and subscribe. That means the most to us. Follow and subscribe, please, please, please. And when you're ready to take action on your own real estate plan, or if you need help with wealth transfer planning, we know a number of experts in all the different spaces. We'd love to connect you with them. You can reach out to us via direct message or comment. You can email us, matt@templeton.realestate. No .com, just templeton.realestate. And I'd be happy to connect you with an advisor. Thanks so much.